I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, Netflix beats projections for earnings in the third quarter, but new subscriptions falter. The company blames price hikes. We have more on the streaming giant's latest earnings report. Plus, turnaround talk. SoftBank may be planning a $5 billion rescue plan for WeWork. We dig into the details. And digital currency revolution. Adam Posen of the Peterson Institute weighs in on whether central banks should be issuing their own guidelines on cryptocurrency. But first, our top story. Netflix reported third quarter earnings on Wednesdays. The shares popping in after-hours trading after international growth eased investor worries. As for the key takeaways, the streaming giant also topped earnings per share projections. New subscribers, however, did fall short of estimates. Revenue climbed 31% to $5.2 billion. For more, I want to bring in Bloomberg's Lucas Shaw in Los Angeles. So, Lucas, the shares rising 10% or so in the post-market. Is it really the new subscribers overseas that are allaying all of our concerns?
I think the story is that investors were clearly worried that Netflix was going to have another bad quarter. They disappointed in the second. They only added a few million customers fewer than people had expected, and investors expected another bad one. You know, one analyst I spoke to ahead of this week said that sentiment was awful, and instead they come in right around expectations. Yes, they were a little bit beneath. They missed in the U.S., but they were above internationally, and that is where Netflix has been telling people for years their future is. It's a sign of where Netflix is going, that while they're going to have one of their worst years ever in the U.S. this year, they're going to have their best year ever internationally, and that's because they have shows that are clearly resonating in Europe, in Latin America, and Asia. And again, in a sign of confidence, Netflix in the upcoming quarter is going to start breaking out its subscribers by region, which suggests that they now feel confident enough in the numbers in some of those areas to talk about it, which they have not previously.
And Lucas, talk to me about the domestic numbers. They're reversing a decline. Is it enough?
You know, I don't know. I don't know how concerned people are. Netflix has cleared the $60 million subscriber threshold, which is what CEO Reed Hastings had long said was kind of the bottom. He projected 60 million to 90 million in the US. This was a while ago, but let's keep using it. They have cleared 60, but they are going to only add about 2.7 million this year. They had historically been adding about 5 million a year. They say it just because of a price hike, and maybe that means that next year they're up to 3 or 4 million, but they also are going to be facing a lot more competition from Disney, from Apple, from AT&T, from Comcast. I think we're probably setting into something of a new reality for Netflix in the US, where after years of growing at 5 million a year, maybe it adds at 3 or 4. If they can keep that going, they'll be okay, because they'll still get to 70 or 80 million in the US, which is a pretty good number, again, provided they are also growing overseas. And the thing to keep in mind is that they are now generating more money from each one of these customers. So their revenue per customer is up, and the margins on those customers are up because the price increases have worked without costing them too much.
My thank you to Lucas Shaw in Los Angeles, covering all things Netflix. And with more analysis on Netflix, I want to turn over to analyst Erik Hagstrom of eMarketer, and he joins me from New York. Erik, what was your biggest takeaway from today's report?
Well, the biggest takeaway is that ultimately subscriber growth is slowing in the U.S. They missed very slightly on their previous guidance, and this is after a negative Q2. What this means going into Q4 and as well as 2020 is that they're not growing as much as they have in the past. That's partially because half of all households in the United States subscribe to Netflix at the moment. And this is really concerning for them moving into this new reality of competition with Disney, competition with AT&T, with Apple. Previously, companies like Disney and AT&T provided a lot of content for Netflix, and they were partners in a lot of ways. Now they're turning into competitors, and this is becoming very difficult this is a difficult problem for Netflix to solve moving forward.
Okay, so you bring up the competition. Let's go there. All we heard from the company was that next quarter will bring some modest headwinds to the company given the competition. How much can they withstand the fact that in the fourth quarter you're getting companies like Apple TV Plus, you name it, Disney coming out. I mean, how strong really is that competition?
Well, there's a lot of excitement around Disney in particular. But the thing to realize as well is that a lot of these other services, Disney, Apple, as well as old competitors like Amazon that still are very, very strong, they don't necessarily have to turn a profit on streaming video on itself. Apple's really using their service to sell more iPhones. Amazon's using their service to sell, more of everything, and Disney's using their service to draw people into their entertainment ecosystem. What this means for Netflix is that they, have to be more careful on price moving forward. When, for example, Apple's giving out their Apple TV Plus service for free with a new device purchase, what this means is that Netflix is going to have to be very more careful moving forward, raising prices, especially if they want to keep their current subscribers.
Although the price hikes are trying to help offset the negative free cash flow, this is the story that we know about the company. If you come and take a look at a chart here that I'm showing in my terminal, it is the classic negative free cash flow that we see from the company. The current quarter has yet to be pulled into that, but again, it's a negative number. That's pretty much all we need to know. What are you hearing from the company about potentially a flatlining to eventually a positive free cash flow scenario?
Well, they raise prices to ultimately improve their profitability as well as their cash flow. But again, the subscriber is the base of their business. When they want to, when we start talking about profitability, cash flow, it all starts at the subscriber. And if they start losing subscribers in their largest market in the US, that's going to be very difficult for them moving forward. I don't think that they will lose, but it's going to be difficult for them to grow moving forward.
You mentioned that companies like Disney there's a lot of hype around it. What company, in your opinion, has the best balance sheet to take on a company like Netflix that's spending $15 billion a year? I've heard rumors Apple TV wants to spend about $6 billion a year on content. Who really here is the best position to take on the original, which was Netflix?
Well, Apple and Disney are positioned very, very well in this space. They have lots of money to spend, and they're both very serious about this. Disney views Disney Plus as really the future of the company as a whole. Everything kind of works off of this new direct-to-consumer streaming service. Apple as well, iPhones are very, very profitable. If they can create a service that helps them sell more iPhones, that's going to be huge for them moving forward. So if they view this as a serious area of growth for them in the future, they will have a lot of money to spend, and they will continue to spend that money. But Netflix is still spending a lot of money to keep up, and notably they're not increasing their content spend, so that's a good sign for Netflix in the future.
Thank you for the dig down into Netflix earnings. That was Erik Hagstrom of eMarketer.
Thanks.
Now, IBM also reported earnings on Wednesday. The company reported revenue that missed the lowest analyst estimate, falling nearly 4% in the fifth period of declines. Total revenue was $18 billion. In July, IBM completed the purchase of open source software company Red Hat for $34 billion. Analysts had looked for signs that that mega deal would drive growth. Shares were lower in after-hours trading. And it seems the U.S. ban on Huawei is not making a dent in the company's sales. China's largest tech company reported a 24% revenue jump in the first 9 months of 2019. Huawei also reported global smartphone shipments rose 26% in the first 3 quarters. However, the company says it expects U.S. export restrictions to reduce annual revenue at its consumer devices business by about $10 billion. And coming up, tossing out a lifeline, SoftBank is said to plan a $5 billion rescue package for WeWork. We have the details next. This is Bloomberg. SoftBank is said to plan a $5 billion rescue financing for WeWork. The funds are coming directly from SoftBank rather than its Vision Fund. Let's get more details from Bloomberg Technologies' Ellen Hewitt. So what do we know so far about this?
So this is one of 2 plans that are maybe in the works that are the subject of a lot of discussions going on this week with the WeWork board. So they are scrambling to figure out how can they keep this company going when, as we've reported in the past, WeWork is set to run out of money as soon as next month. So as you mentioned, there's this new deal that we have some details on, a potential proposal from SoftBank to invest something around $5 billion in the company. That would give them a much larger stake in the company, although, as we've reported, not a majority stake.
Now, do we know if this is in lieu of the JP Morgan deal or instead of?
It seems like these are both on the table. They're pretty different. So one of the major decisions that the board is going to have to deal with this week and into next, depending how long it takes them to make this decision, is which one is better for the company, which one is going to provide them a better path forward. So the JPM deal, as you mentioned, is around the same amount of money, $5 billion, but in a somewhat complicated debt package. So they're trying to pick.
And with this SoftBank deal, do they get control of the company?
They do not, as far as we understand it, get majority control of the company. You have to remember Adam Neumann, even though he's no longer CEO, he's still a board member. He still owns a lot of stock. Obviously, in a transaction like this, some of that ownership could change, but he still has super voting shares. SoftBank could be looking to get non-voting shares or some combination of different shares. So they'll be taking on more of a stake in the company. Their control not necessarily guaranteed.
So then what would be the new valuation?
That is a remaining question. It's definitely going to be lower than this $47 billion kind of high water line that came up earlier this year. It seems like the ranges are all over the place, but it could be maybe as low as under 20, maybe under 10, who knows?
We talked a few days ago about sort of the reputational to SoftBank by putting up this money, what that says about, sort of the whole deal that all fell through. What is the downside for SoftBank in this?
I think it could, if it ends up going poorly, could really be seen as good money chasing bad, right? Like they have already invested, as we've talked about, more than $10 billion in this company. They're obviously attached to the outcome of what comes out of WeWork, although this plan makes it, then it's almost like WeWork becomes a SoftBank company. It would be something where they would probably have a great say in installing maybe potentially a new CEO to replace these co-CEOs who came from WeWork. It could end up being something where they feel very responsible, and the narrative suggests that SoftBank then kind of becomes responsible for whether WeWork ever really makes it out.
I have a feeling we'll be having you back a few more times this week to get the latest. That was Bloomberg's Ellen Hewitt. And I want to switch on over to bank earnings, specifically Bank of America. Shares of the bank rallied after reporting better than expected earnings per share. The company also showed it's remaining disciplined in managing expenses. Here to tell me more about Bank of America and the digital banking status, it's Bloomberg's Sonali Basak in New York. So Sonali, what do we know about sort of the digital initiatives from Bank of America?
So something that's interesting that I think a lot of Wall Street realizes about these big banks, but I'm wondering if Silicon Valley has caught on to, is that these banks are under a lot of pressure to rake in more money at a time where interest rates are very low and only getting lower right now. And so Bank of America is very highly exposed to that. So they have to try to figure out how to bring in more money when their net interest income, their biggest driver of money, is under pressure. And their expenses are flat. So you see a race here to figure out a way to spend more money, especially in digital initiatives, which ends up being almost $3 billion quarterly at a time where their revenue, their main driver of revenue, is also under pressure.
And is Zelle, peer-to-peer payments, the way in which Bank of America is trying to push forward that initiative?
When you look at Bank of America's numbers, Zelle is definitely the most compelling chart. You see that 80 million transactions is almost double than where it was a year ago. However, the users, almost 9 million, are about the number of users that it has for Erica also. So do you count it by the number of users? Do you count it by the number of transactions? People are certainly using it more, but does that mean that adoption is ticking up significantly? It's a weird thing because you have Bank of America and JP Morgan both investing in digital branches at the same time that they're also investing in technology. And so you can see them hustling here to try to get consumers in two ways.
Sonali, you mentioned JP Morgan, and Jamie Dimon came out and talked about this. He said, fintech is always going to try to eat your lunch. I think it's good. It's called American capitalism. We have to stay on our toes to compete. From these earnings so far from companies like B of A and JP Morgan, have they done enough to take on the competition that is fintech?
You could see them still wanting to pour the billions of dollars it takes into technology to really compete here. But you got to wonder, when Jamie Dimon says fintech, we do see record volumes of money going into the fintech community, but is he talking about the smaller upstarts, or is he really talking about the Apples and the Amazons of the world that really pose a threat to the banking community, both in terms of whether they get into more financial products or whether they steal more talent from the banking industry, right? Facebook has already said that they are willing to hire hundreds of engineers in New York, and poaching from the financial community is not a rare thing for them to do. It's certainly something they do.
And within the disciplined expense management, we take a look at the right-hand side of that income statement. Any sense of what percent of total expenses is going towards investments in technology, hiring those coders, you name it?
So let me give you an example here. And so in one quarter, non-interest expense for Bank of America is about $15 billion. So if you take about $3 billion, right, a little bit more than, a quarter of the 12 that they almost spend every year, you have about a fifth of non-interest expense. So it's definitely a big technology spend. JP Morgan, Bank of America leading the pack here because they have really big consumer arms that could use more digital banking services, which tends to be a leader in terms of all technology that big banks use.
Pulling in tech and banking, Bloomberg's Sonali Basak, thanks for joining. And coming up in the year of big tech names like Uber and Lyft going public, the results have been mixed. We speak to a CEO who knows a thing or two about IPOs. That's Frank Slootman. This is Bloomberg. Pinterest shares fluctuated on Wednesday after a large block of shares was said to change hands overnight. However, analysts are saying that the deal probably doesn't reflect negative sentiment around the stock ahead of earnings this month. Sources say Goldman Sachs was managing the 4.68 million share block trade on behalf of an unknown holder. This came the same day that selling restrictions lifted for insiders and other pre-IPO shareholders. So while Pinterest is a newly public company, there are still a bunch of private ones trying to make that leap. One such company that may have its eyes on a public debut is Snowflake. It sells a cloud-based data warehouse service that helps organizations such as Netflix store and analyze information. And it's valued at under $4 billion. Joining me from New York is the CEO of Snowflake, Frank Slootman. So Frank, great to have you here. Let me just start with some of the hot IPOs that maybe haven't gone so well. You have companies like Peloton and Smile Direct where you think there's a good business, they don't do so well. How much of these are idiosyncratic concerns versus maybe a larger macro concern about the economy?
Well, I'm personally very fond of Peloton. I think they have a good product. Then the thing that we got to stay focused on, do they have a viable business, right? Whether the market is hot or cold in the company from one day to the next is not as important as whether the company it has real velocity, has real momentum, and can really sustain itself over the long haul. I don't have an opinion, specifically on Peloton, but those are sort of the parameters I would watch for any company that's newly public. You want to be able to sort of blast through your first 4 quarters of being public and have a really good showing that way.
How does the IPO market feel to you right now? Is it healthy because companies are getting shaken up if they're not profitable, or is it too volatile?
No, I think it's actually healthy. I mean, there should be a high bar. It felt to me too euphoric for a period of time. I'd rather have investors be critical, be testy, and really examine companies so that when they come to market, the public can really have the confidence these are real companies with real velocity, real momentum, they're viable, and they have been properly vetted, right? There's nothing worse than companies coming to market, falling apart after an IPO. That's not good for anybody.
How has the environment affected Snowflake's plans to go public?
Well, it hasn't affected it at all. We're focused on running our business. We're preparing the company to go public. And we'll find our window, whenever that comes, we'll pull that trigger and go. An IPO is a milestone, but life continues on, right after. So we don't get too excited about it.
Would you prefer a direct list or an IPO?
Yeah, the DL, the direct listing, really is an obvious choice when you do not need to raise money. There shouldn't be too much discussion beyond it. If you do need to raise money, then the choice between an IPO and a direct listing is not as obvious. There's a lot of advocates these days for a direct listing and then doing a private placement ahead of a direct listing. I don't find it that obvious. One of the great things about the IPO process is that it is a real price discovery process, whereas in the private placement, it is just very hard to know whether you're pricing the company at a market value. We've seen sort of really glaring examples where people have either under or overpriced private placements, and the experience we have with IPOs over decades and doing thousands and thousands of them is that we're pretty good at discovering that price and then having the companies go public in an orderly manner.
I want to talk about the fundamentals of your business. You compete with Amazon. You do it really well. What are you doing right?
Well, we're very focused on what we do. We're good partners, with Amazon. We like working with them. Of course, we compete with them as well, but we are absolute specialists in what we do. Amazon has many other products. It's not always easy to compete with somebody who is very, very determined on succeeding in its core business, and that's what we are.
And talk to me about the new customers that you're getting. Are these new customers, or are you cannibalizing them from another company?
Well, I mean, the way it is in business, you're always taking somebody else's money. But oftentimes, we replace legacy on-premise systems. People that want to go to the cloud, that want to have the utility model, the elasticity, the performance, the scale, all those good things. They always come from somewhere. There are what we call greenfield projects where there was nothing before. We do new things, but by and large, something gets displaced by the entry of Snowflake.
You previously ran ServiceNow. What did that experience in taking them public teach you about the current environment?
ServiceNow was a terrific experience for us. I took a company in 2007, public as well. So we sort of have the combined experience of those two companies. What's really important is that when a company goes public, you have the velocity and the momentum to really have a very, very good showing within the first several quarters post-IPO. And operationally, it means you have to be very capable of forecasting your business, not just at the top line, but the bottom line, cash flow, all those things. That will provide a lot of confidence in the markets. If you can't do that, if you don't have the velocity and you don't have the fidelity in forecasting, it gets to be really hard being a public company. And that's really what should throttle the timing of people wanting to go out. Going public, being public, things are not going to get any easier.
All things on the market, IPO, direct listing, great conversation. Snowflake CEO Frank Slootman, thanks for joining me. And coming up, we'll hear from Adam Posen of the Peterson Institute on whether central banks should be issuing their own digital currencies. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Now to a story we're following in the digital currency revolution. On Thursday, the G7 will release broad guidelines for regulating digital money. Also up for discussion if central banks should be issuing their currency. Already, Sweden and China are studying that topic, and the Bank of Canada has launched a formal research project that has partnered with other monetary authorities. To discuss in Washington, it's the president of Peterson Institute for International Economics, that's Adam Posen. Adam, first give me your takes on yes or no if central banks should be involved in digital currencies.
Yes, I think they should be, but in two senses. First, they've got to regulate and keep away regulatory arbitrage that basically would exploit average people or small businesses if you have private currencies that are not regulated. Second, central banks should be involved because they can provide efficiencies and safety that make private currencies irrelevant. But third, they should not be getting involved just because it's digital, just to save people money. They should not be getting involved to try to be able to drive down negative rates. As Governor Lael Brainerd said at a speech earlier today at Peterson, those are not really motivations you want to have, and I agree with her.
Well, I want to get to the Fed because a lot of international central banks have started to weigh in. Is there a risk that the Fed is moving too slowly on this?
I don't think so. I think it's a fair question, and you mentioned both the People's Bank of China and the Swedish Riksbank, which are definitely leaders in this space. Sweden, having a very high-income economy with a very sophisticated both financial system and population, is in a position that it can afford to experiment a bit, but also because the Swedish Riksbank has a lot of credibility and they are able to keep ahead of the private sector. For the U.S., if the U.S. is slower and the Federal Reserve is understandably a bit cautious, I don't think there's any big losses here. This isn't like a private sector race. Whoever gets there first wins.
And you mentioned Kaplan and Brainerd, all of which have come out with comments saying that the Fed is actively looking at issues on digital currencies. And then Governor Brainerd saying that a currency solution is not a solution to a zero lower bound. Walk me through that.
Yeah, that's what I made reference to her remarks, which I, as it happens, agree with. The idea is, one argument that a number of theoretically minded economists have made is that if you have a digital currency, then it's easy for the government or the central bank to erode the value of that currency, to basically inflate it away once it's totally under the government's control. And the advantage of doing that is not to rip people off, in theory. It is to allow you to go as negative on interest rates as you need to be without having to go through the banking system, without having other problems. But I think Governor Brainerd makes an argument, and I certainly would make the argument, that it's probably destabilizing to the financial system. It causes people to want to move their money out. It may cause runs on various institutions, if not the currency. And ultimately, there are other ways of achieving your monetary goals than trying to go negative with rates. So that particular piece of the argument, I think, should be killed, and killed soon.
Adam, does the issue of digital currency need to be a central bank issue, a Department of the Treasury issue, or a congressional regulation issue?
That's a really astute question. It's astute for two reasons. First is because it is a public interest to determine what is the value you're trying to serve by putting this in place, and that, frankly, should not be up to the Fed to decide. And second, because right now we don't really have an appropriate regulator or supervisor in the U.S. system. The Fed can regulate interbank payments in a limited way, but there's nobody. In theory, the Financial Stability Oversight Committee could take in if they decided this was systemic. So I think it is not so much a Treasury. I think it is actually a legislative issue. I would like to see Congress talk about and then legislate what goals they think such a digital money should serve for the U.S. public.
Well, Adam, one individual who has an opinion on that is David Marcus, who heads up Facebook's Libra cryptocurrency. We spoke with him yesterday. He did say that government's sort of holding back regulation. Take a listen.
For these types of letters to be circulated for a thing that's an idea, a project, and telling people you should not explore innovation and a project at a time where not only here in this country, but all around the world, the core of our financial system hasn't evolved much in the last 50 years, and consumers all around the world are paying the price for it. I think, we should ask ourselves whether this is the right approach if we want to really lower cost and lower the barriers of access for financial services for all of the people who deserve so much better in the world.
Adam, what do you make of those comments?
Somebody's talking their book. It's very nice to make appeal to lowering costs and to financial inclusion. Financial inclusion can be much better served by various legal changes to make it so. For example, we have Treasury Direct, we have direct deposit for government payments. We have a number of ways we could restrict check cashing fees and other fees. There are a number of things we can do to do financial inclusion, and that's just in the U.S., let alone around the world. The key thing is to get people to have essentially know your customer IDs. That was the great leap forward in India, and we've also seen stories when that's done badly, people get cut out. This is very serious business, but it has nothing to do with a Libra. It has to do with a public commitment to having IDs for people and giving some value for those IDs and not abusing the information that goes with those IDs. And all of those I would not be willing to trust to some profit-centered, self-oriented, privacy-ignoring company as opposed to a government that is well regulated. Even then, the government would have to be watched. Finally, it's not just about driving down costs. Again, poorer people are exploited in the U.S. because of their lack of access to banking and the payment system. There are ways to fix that. The main reason you want to move to digital currency is to create other efficiencies in the economy and actually, frankly, to prevent people from getting circuited and getting their privacy and finances ripped off. It's not mainly to save costs.
Adam Posen of the Peterson Institute, thank you for joining me. Now, sticking with cryptocurrencies, but it's a much darker side of that technology. U.S. and Korean authorities say they broke up one of the world's largest markets for child pornography. Prosecutors say that the suspect operated in a darknet market that accepted Bitcoin and distributed more than 1 million sexually explicit videos involving children. Joining me to discuss in Washington, it's Jamil Jaffer, Vice President at IronNet Cybersecurity. Jamil, first, talk to me a little bit about the ins and outs of this story and using Bitcoin now to be able to trace and find the suspect here.
Yeah, well, of course, Taylor, the whole effort with Bitcoin has been to anonymize transactions and to allow people to engage in assured transactions, but where it's not known who they are. And of course, what happened here was the police, the IRS in particular, working with the criminal division of the Justice Department and the DC U.S. Attorney's Office, were able to de-anonymize these transactions, identify the people involved, and identify the guy, the 23-year-old South Korean man who's hosting over 1 million downloads, 250,000 individual files, almost half of which had never been seen before. So the scale of this exploitation of young children is exploding, and Bitcoin is enabling this. And now we're using Bitcoin to actually identify these people, track them down, and put them in jail for their activities. Over 300 arrests in this case alone, Taylor.
So you took me exactly where I want to go. Bitcoin gets a bad rap for instances like this. But if we're able to also use it towards catching the bad people, catching the bad guys, cracking down on these illegal activities, couldn't we then also make the case that in this instance, Bitcoin is helping?
Well, I mean, obviously we were trying. What happened here is that the government was able to sort of undermine the nature of Bitcoin, right? The anonymous nature of it to identify these folks. And it's unclear how they did that, right? One way you might think is a lot of people have different identities online. If you're able to access large corpuses of breached data, you might be able to de-anonymize transactions. That way people use common passwords, people use common email addresses, the like. That might be one way to de-anonymize. But the nature of the Bitcoin system is twofold. One, it's anonymous, but also it's permanent and a detailed record of who transacted with whom. So once you find one bad actor, you can trace their entire network of activity, identify who else transacts with them, and if you can de-anonymize it, that's hugely powerful. The same way the federal government used the 215 metadata program to identify terrorists back in the day.
So generally, this is how the IRS, the feds, can track a bad actor, right? They can go in and be able to find it. And once you find one, you can find everyone else within illegal activity.
Exactly right. And now we've got 330 people, right? If they were smart, what they'd do is try to figure out who those people have in common. Who are they all transacting with? These are people into child pornography. They're clearly trading it on this website that had a huge amount of images, right? Who else are they transacting with? A lot, right? Maybe those people are involved also, right? And you can see where those people are transacting with known bad sites. And then if you can de-anonymize those, and that's the real trick here, is this de-anonymization, identifying their location. If you can do that at scale and speed, that can be hugely powerful. And there are companies out there that are in this business as well as in the crowdsourcing of intelligence. Those companies may be poised to really do something interesting based on this new capability to de-anonymize stuff.
And any sense that regulation would help in this instance, or bad actors will always find a way?
Well, look, I mean, I'm generally skeptical of regulation in this space because of the fast-moving nature of the technology. It's hard for regulators to keep up, to just be candid, and laws have a hard time keeping up. Regulators, I mean, you look at the hearings on Facebook on Capitol Hill, and you're sort of appalled at the level of knowledge of members of Congress. And some of these are young members, and it's still hard for them to keep up. It's hard to imagine regulations keeping up. That being said, in this kind of area where we're talking about child pornography, the government's got to get aggressive. They've got to work tightly with industry. They have to partner, and they've got to be able to go identify these people, because whether it's a child pornographer today, it's a terrorist the next day, we need to be able to have this access and identify these people and put them in jail.
Wonderful points being made. Jamil Jaffer of IronNet, thanks for joining me. And coming up, we'll hear from Bill Gates on the role government needs to play in regulating technology. That's next. This is Bloomberg. Tuesday night's Democratic presidential debate featured candidates weighing in on the issues facing tech and society, and they had plenty to say.
Using a 20th century antitrust framework will not work. We need new solutions and a new toolkit.
I'm not willing to give up and let a handful of monopolists dominate our economy and our democracy. It's time to fight back.
I agree with Senator Warren that, in fact, monopolies have to be dealt with. They either have to be broken up or regulated.
Right now, we treat them functionally as a utility, when in reality, they're more akin to a publisher. Treat them like the publisher that they are.
Senator Warren, I just want to say that I was surprised to hear that you did not agree with me that on this subject of what should be the rules around corporate responsibility for these big tech companies, when I called on Twitter to suspend Donald Trump's account, that you did not agree, and I would urge you to join me.
If we're going to talk seriously about breaking up big tech, then we should ask if people are taking money from the big tech executives.
Joining me in New York to discuss, Bloomberg's Erik Newcomer, who covers the intersection of tech and politics. So, Erik, how much was big tech under attack?
You know, it's a total free-for-all. Everybody knows that they should be mad at tech, but I don't think they all agree exactly what should be done about that public anger. So it's, you know, everything from antitrust to privacy to election interference, and one idea after another. So a lot of different ideas thrown at the wall there.
Who had one of the more realistic plans in your idea, a real actionable solution?
Well, you know, Elizabeth Warren has put out a specific plan that calls for breaking up Google, Facebook, and Amazon. I mean, that's a pretty drastic proposal, but it's, you know, fairly specific. On the other hand, Kamala Harris, you know, is really pushing this idea on Warren to push Trump off Twitter, which seems to just, you know, be trying to empower a tech company, you know, say take on more responsibility, where Warren has really been pushing for the government to step in and sort of humble these tech giants.
There's also a lot of debate about removing President Trump from Twitter and removing his account. What are those claims?
Yeah, so I think there are a lot of people that worry that, you know, any head of state could post some, you know, threat of war or something truly dangerous, and that Twitter, just like it sort of looks through other people's tweets to decide if they cross certain lines, should apply to the same rules to a president, and specifically to Donald Trump. And that's what Kamala Harris was talking about there. You know, the counter argument to that is just that this is, you know, when you talk about a public figure, he's sort of the ultimate public figure. And for a company to step in on what a president can say, you know, is a super controversial idea.
And then we push forward to 2020, a lot of discussion on election security. Is Facebook the only target when it comes to election security?
You know, Facebook, Twitter, Google all play a part in getting information to the public. So it's certainly not just Facebook, but there's, you know, the history there. They have, you know, control of not only Facebook, but Instagram and WhatsApp and Facebook Messenger. So I think Facebook is certainly central to that. And I think, you know, there isn't a lot of confidence that the problems of 2016 have been cleaned up this time around.
Bloomberg Technologies, Erik Newcomer, thanks for joining me.
Thank you.
And it's not just presidential hopefuls debating tech regulation. Bloomberg's David Rubenstein sat down with Bill Gates to get his thoughts on the hot button topic.
Now, the largest companies in the world and the United States today are technology companies: Apple, Facebook, Google, Microsoft, and so forth. Do you worry that there's too much power and too much data in the hands of these technology companies? And are you surprised the government hasn't done something more than they've done to date about this?
Well, technology's become so central that government has to think, okay, what does that mean about elections? What does it mean about bullying? What does it mean about wiretapping authorities that let you find out what's going on financially, or you know, drug money laundering, things like that. So yes, the government needs to get involved. I, for the early years of Microsoft, bragged to people that I didn't have an office in Washington, D.C. And eventually I came to regret that statement because it was kind of almost like taunting Washington, D.C. And So now the technology companies, partly because of the lesson of Microsoft, of course, they could have seen that lesson through AT&T or IBM or Kodak or a lot of innovators as well. They're very engaged. There will be more regulation of the tech sector, things like privacy. I'm sure and there should be at some point federal regulation that relates to that. The fact that now this is the way people consume media, has really brought it into a realm that we need to shape it so that the benefits outweigh the negatives.
That was Bill Gates speaking with David Rubenstein on Peer-to-Peer. And as a reminder, tune into the full interview where the two dive into a wide range of topics, including making climate change a bipartisan issue. And still ahead, Volvo announces bold new all-electric vehicle. We hear from the CEO next. This is Bloomberg. Volvo is entering a new space. The European automaker has unveiled plans for its first all-electric vehicle. Its goal is to cut the carbon footprint on each car by 40% by the year 2025. Volvo CEO Håkan Samuelsson spoke with Bloomberg Sherry On and Amanda Lang.
From day one it will be profitable, but of course in the very low volumes you have to understand that the cost level will be higher, so it might be a lower profit margin initially, but I think what counts is a bit more mid-term, and then we definitely believe that an EV car will have a higher value for the consumer, and long-term it's absolutely the right thing to do.
So when you talk about the subsidizing the charging costs, just how did you come to that as a decision to help push this car?
It's really not related to the all-electric cars. That is, we will now promote really the sales of the so-called plug-in hybrid, which you could call a part-time electric car. And that's, of course, very important that you really charge that and not just fill in gas and drive it as a conventional car. So we follow this very closely in our monitoring of the car, and right now it's around 40% of customers buying a plug-in are using it electric 40% of the time, and we want really to incentivize customers to really charge it even more, and that's why we say first year electricity is included in the price of the car when you buy a plug-in hybrid recharge car from Volvo.
So where will these cars be made? Will they be at all affected by tariffs?
Yeah, they are made really in Charleston. Some models, others are made in Torslanda. So I would say there is no really connection to tariffs. Tariffs is really a problem for us for electric cars, plug-ins or conventional. So I mean, our global production system is based on that some cars we build in one location and trade. High volumes cars we build locally. But I mean, if we would have trade restrictions and we're forced to build all cars locally, it would of course be the additional cost for our consumers. So we hope that will not be the case looking forward.
So we have seen also the Chinese government now reduce those subsidies for new energy vehicles. Are you at all concerned about EV demand within China?
Yes, I mean the subsidies has gone down, and of course it's always helpful with governmental support introducing a new technology. But on the other hand, we really believe if electric cars are going to fly long term, it has to be sold to customers who are ready to pay for it. It has to be attractive products, competitive on the free market. Otherwise, you just have temporary subsidies. Will not help the climate. That's why we are so sure about that. If we want to participate in a better climate, we need to do it with attractive products sold on the free market.
And to Sherry's point, as you do move beyond those subsidies, you want obviously to get to volume. Is China the market for you? Will there be mass purchases of these kinds of vehicles there?
I think all markets, I mean, here in the west coast of US, for example, it's a very big market for electric cars, but also in Europe there is an appetite for electric cars. I think so far the interest in China has been, to a large degree, been based on incentives. So I think, but also the Chinese market will pick up and see the beauty of an electric car. But it's also based on that you have somewhere to charge the car overnight. It's very difficult if you park the car on a street in a big city. I think those customers will be the last one going electric.
That was Volvo CEO Håkan Samuelsson. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.